Welcome to Breaking News to Trading Moves. Today, we're looking at one piece of news that really got the market talking. The report that Target, that's ticker TGT, is facing pressure from an activist investor.
Exactly. And that headline is really the whole story today. For you, the goal here is to understand how just one campaign against a retailer of this size can start to, map out the potential winners and losers across the whole sector.
Right, from their direct rivals all the way to the advisory firms who just love these kinds of fights.
They absolutely do.
So let's set the stage. I mean, it's no secret Target's been dealing with some pretty lukewarm sales, especially in those non-essential categories. And the stock has lagged a bit this year. What's the new development here?
The development is a firm called Tom's Capital Investment Management, or TCIM. They've reportedly built up an undisclosed stake in Target. And, activists don't just show up for fun.
Yeah.
They show up when they think there are specific correctable failures that can unlock value and potentially lead to a re-rating of the stock.
Okay, that term re-rating. Can you break that down for us? What does that actually mean in this context?
Sure. It just means the market decides the company deserves a higher valuation, a higher multiple on its earnings. The activist argument is that because of poor management or inefficient operations, Target stock is cheap compared to what it could be. TCIM's presence is meant to force changes that prove the company should trade at a higher price.
So what are those specific pressure points? What is the market expecting TCIM to actually push for?
Well, this is what creates the near-term action. The pressure will be on the nuts and bolts of the business. We're talking a really deep look at their cost structure.
Right, cutting costs.
Always. Then better merchandising execution, which is just a fancy way of saying get the right products on the shelves at the right time. And, of course, a full review of their pricing strategy.
Especially where they go head-to-head with Walmart and Amazon.
Exactly. And then there's the financial side. Capital allocation is always a core activist topic.
Right. How are they spending their money? Are they buying back stock or are they reinvesting it?
Precisely. Is the company spending too much on long-term projects versus just returning cash to shareholders through buybacks? You can expect some very intense discussions around that balance.
I thought I read that Target already has some big investment plans for stores and digital slated for 2026. How does an activist play into that?
It just raises the stakes. It raises the execution bar. Target has basically bought itself a window of time to prove that its own strategy works. If customer traffic and what we call comps, comparable sales, don't pick up after this spending,
Then the activists have their opening.
a massive opening to escalate their efforts. It puts management under a microscope with a clock ticking.
So the TGT ticker is almost like an alarm bell for the rest of retail.
That's a great way to put it. This campaign is a signal about where smart money thinks the easiest fixes are in the big box retail space. If a name like Target is seen as having these weaknesses, it suggests others do too.
Okay, that sets the stage perfectly. So let's move beyond Target itself. When news like this breaks, who does the market see as the beneficiaries? Let's start with maybe the most obvious one, Target itself.
Correct. The goal is to increase shareholder value, so the top potential beneficiary is Target, ticker TGT. Just having that demanding investor in the room tends to force management toward better, faster decisions.
And that often gives the share price a little bump, at least in the short term.
It often does. And then you get this sympathy effect.
A retail turnaround story.
Exactly. When an activist targets a big household name, investors start looking for the next domino to fall. They start asking, okay, if Target can be fixed, who's next? And they start revaluing other potentially fixable retailers.
So is there a key name that gets pulled into that sympathy play?
Kohl's, ticker KSS. It's
Yeah.
often mentioned here. It has faced activists in the past. It's definitely a name to watch as a direct sympathy play.
Okay, so that's category one. What about the second group of winners? The value leaders. How do they benefit?
This is all about scale. If Target is forced to get more promotional, to slash prices, to win back traffic,
Which they often are.
the whole retail space becomes more competitive. The companies that are built to withstand that are the ones with massive scale and the best supply chains.
You're talking about a logistical moat. So who are the tickers here?
We're talking Walmart, WMT, and Costco, CoST. I mean, they have invested billions in their infrastructure. If Target starts a price war, Walmart and Costco can often absorb those margin hits much better, or even undercut them. You should probably keep Amazon, AMZN on that watch list too, for obvious reasons.
Right. Their digital scale is its own kind of moat. Okay, this third category is where it gets a little different. The groups that don't really care about the products, they just care that the process is happening. The advisory and restructuring ecosystem.
Yes, the high-end professional services.
Hmm.
Activism means strategic reviews, defense work, portfolio reshuffles. All of that generates very large fees.
Break that down. What are these firms actually doing?
They're advising Target's board on how to defend itself. They're writing models on what businesses to maybe sell off. They're looking at real estate. It's complex, high-stakes work. And it means big revenue for firms like Evercore, EVR, Lazard, LAZ, and Houlihan Lokey, HLI.
I imagine when a company the size of Target is in play, their phones are ringing off the hook.
They are definitely anticipating a busy year.
Okay, so that's a clear map of the beneficiaries. Let's flip it. Who are the potential losers here? If Target gets more aggressive, whose business model is under threat?
You have to start with the dollar stores and the small box discounters. The top potential loser here is Dollar General, ticker DG.
And why is DG so exposed to a more aggressive Target?
Well, Target's weakness has been in things like clothing and home goods. But they still sell a ton of essentials groceries, cleaning supplies. If an activist forces Target to get really sharp on pricing for those basic items, it creates a huge problem for the trade-down retailers.
You mean the shoppers who shifted to dollar stores for everyday things during the inflation spike?
That's the group. If Target makes its essentials compelling on price again, those shoppers might just trade right back up. And that forces the discounters, including Dollar Tree, DLTR, to spend more on their own promotions, which hurts their already thin margins.
Okay, second loser category. The mall-based department stores. They're already in a tough spot.
A very tough spot. The same consumer weakness that's hurting Target's discretionary sales is hitting these stores even harder. I mean, they depend on apparel sales and foot traffic, and both of those are challenged.
So if Target does manage to get its act together, it could pull even more traffic away from them. Who are we talking about here?
Macy's, ticker M, and Nordstrom, JWN. These companies are already trying to right-size their businesses. More competition from a newly energized Target just makes that uphill climb even steeper.
Got it. And the last category here is about companies sensitive to sourcing and margin risks, specifically home and discretionary goods.
This is a classic double squeeze situation. On one side, you have uncertainty around tariffs, which can raise the cost of goods they import. On the other side, you have a consumer who is pulling back on spending for big, non-essential items.
So their costs go up and their revenue goes down. Hits them from both sides.
That's exactly it. Retailers who rely on big-ticket imports for the home, they just face this immense margin pressure if their costs rise or if people just stop buying expensive furniture.
And that would be companies like RH and Williams-Sonoma, WSM. They have a less price-sensitive customer, but it's still a highly discretionary purchase.
Correct. Their entire model depends on people being willing to spend thousands on a sofa or high-end cookware. Any kind of consumer anxiety, whether it's about price or the economy, hits them directly.
This has been a really useful breakdown of how the market works off a single headline. For the listener, what's the big lesson here?
I think the key takeaway is seeing how activist capital, like TCIMs, is sort of a thermometer for the market. By targeting what they see as weak execution at a big company like Target, they signal where the next areas of opportunity and vulnerability are across the whole sector. You can really use this one campaign as a lens to look at every other retailer we mentioned today.
That's a great way to frame it. And considering what we've discussed about the consumer pulling back and the sensitivity to import costs, here's a thought for you to take away. If this activist pressure succeeds and it forces a major retailer like Target to double down on offering cheaper, import-heavy goods just to drive sales, what's the long-term effect of that? What does that kind of pure price competition do to customer perception versus, say, maintaining product quality in the U.S. retail space?
A reminder that this discussion is purely the opinion of the author and is based solely on the material provided. This is not financial advice, nor is it a recommendation to buy or sell any of the securities mentioned.